Nearly 3.9 crore Indians hold approximately 20,000 crore in digital assets at the end of May 2026. However, only about one-fourth of the 6,45,000 individuals who transacted in crypto during FY 22-23 reported the same in their income tax returns. A recent report suggests that Indian tax authorities are very much concerned about this underreporting of cryptocurrencies, particularly those conducted through offshore exchanges, private wallets, and P2P platforms. Many investors believe that Indian exchange पे ट्रेड नहीं किया है, प्राइवेट वॉलेट में है, P2P transaction है, so the government will never come to know. But that is not necessarily true. The income tax department can connect information from your bank account, UPI transactions, KYC records, TDS details, AIS, that is annual information statement, and information received through investigations or international information sharing arrangements. Now, understand the tax rules. Income from transfer of virtual digital assets is generally taxable at 30% subject to applicable surcharge and cess. Only the cost of acquisition is ordinarily allowed as a deduction. You generally cannot adjust one crypto loss against another crypto gain, and the loss cannot be carried forward under the special VDA taxation framework. The existing regime also contains a 1% TDS mechanism for covered VDA transactions above the prescribed limits. For example, if you purchased one crypto asset for rupees 1 lakh and sold it for 1.6 lakhs, your taxable gain is 60,000. Now suppose you lost 40,000 on another crypto asset. You cannot simply say net profit is only 20,000. So tax me only on the 20,000 rupees. The special crypto tax provisions do not generally permit that set off. And P2P transactions are not tax free merely because no conventional exchange was involved. Depending on the transaction, the buyer or another responsible person may have a TDS obligation. Therefore, both the parties should preserve wallet addresses, transaction IDs, date and time, bank or UPI evidence, purchase cost, sale value, and the exchange rate used to convert the transactions into rupees. Also check whether the exchange is registered with FIU-India. India requires VDA service providers operating in Indian market to comply with anti-money laundering requirements. Offshore exchanges have previously faced blocking action and substantial penalties for non-compliance. One more important point. Crypto taxation does not mean that the government has approved crypto as a safe or regulated investment. Taxability and regulatory approval are two different things. So before filing your return, download the complete transaction history from the exchange and the wallet, reconcile it with your bank account and AIS, identify your P2P transactions and calculate the gain transaction wise. In your crypto, the biggest risk may not be the fall in price. It may be the transaction which you forgot to disclose. Save this video and share it with someone who invests in crypto.